I think one of the things, particularly with the failures we had in the States as a signal, this is the first banking crisis of the Twitter era. I mean, yes, Twitter did actually technically exist in 2008, but barely. There was no TikTok, there was no Instagram, and I think we have to remember that what social media has done is increase the importance of reputation perhaps exponentially. And that's part of this problem, I think, because you can now almost frictionlessly pull money out of a bank. You don't have to queue up outside. There were no queues up outside banks in the way that there were with Northern Rock here in the UK back in 2008. That didn't happen this time because you just, go online and click a couple of buttons and off you go. So I think that there's a need to re-examine the role of reputation and what that means. But I think the implications of this for the economy are also particularly important because, to your earlier comment on the labour market, I don't think we've got a tight labour market. It's very hard to describe the labour market as tight after 2 years of catastrophically negative real wages. And what's been happening, of course, is credit in the States, particularly in recent months, has been propping up the consumer. Now we've got a question about whether credit conditions are going to be tightened as a result of what's happening in the financial sector. And so this creates a series of really quite complicated issues to deal with.
I find myself in the rare position of 100% agreeing with you about the revolving credit, for instance, which is looking horrendous as well. And yet people keep telling me, and coming on the show, and probably saying to Julian as well, oh, no, the household balance sheet is fantastic. Oh, maybe they're... And someone actually came on the other day, and this is more anecdotal, saying, oh, well, they're just too busy at work to look at the fact they've got a credit card balance at, like... And I'm like, there's 19%! That's nonsensical. But anyway, I did tell that specific gentleman what I thought. But more importantly, the complexities of the banking sector as well. How much more do you think is still to be uncovered as well? I love the fact that they've been handing out money left, right and centre. But I mean, this is 101. This isn't some sophisticated mortgage-backed product sold to a Norwegian investor or something from a devious Wall Street broker. This is sovereign bonds being priced at X and then not being repriced at Y once the yield picks up aggressively as well. This is basics.
It is. It's, interest rate risk is, economics 101 for most banks. But of course, what we've got to remember is that...
I did Lipsy in 1988 with this, Paul.
Exactly. I'm delighted to hear you once read an economics textbook.
I tried one of yours once as well.
The issue here is, I think, that we've got a number of institutions which have come along a bit more quickly, SVP in case in point, where they're not used to this sort of risk. They haven't necessarily built this into their structure. Now, one can say, well, perhaps the 2018 dialing back of regulation in the States contributed to this problem, and I think it probably did. That there should have been better oversight, etc., etc. But this is always the problem in the financial sector. Regulators are fighting the last war, which was around credit risk, not the current war, which is, yes, more about interest rate risk. And I think as well, this is something we've been very critical of with the Fed and with the ECB from an economic point of view, but I think it also applies from a financial point of view. You don't just hike rates relentlessly, hike, close your eyes to everything else and just say, no, we're on autopilot hiking. You do pause from time to time to assess what the hell your policy is doing to the economy and the financial sector.